Good morning, and thank you for joining us for the Burgess Hodgson Autumn 21 Budget Questions and Answers. The budget is a statement made to the House of Commons by the Chancellor of the Exchequer. It has two elements. First, it sets out the government's view for the nation's finances, both in terms of recent performance and the best guess on forecasts for the economy estimated by the Office for Budget Responsibility. And secondly, it sets out the government's proposals for changes in taxation. We will naturally be focusing on the second element of the budget, the announced future changes to taxation, and possibly more pertinently, how these changes should affect your tax planning. Your panel for our session comprises three of my partners, all chartered accountants: Ken Jones, Richard Stewart, and Simon Bailey. Ken Jones is the Burgess Hodgson go-to man on technical issues with an unmatched ability for distilling complex formal texts into clear ideas. Perfect for interpreting the budget. As well as running a full portfolio, Richard Stewart runs our bookkeeping and management accounts team, so he is very aware of what any updates mean at the coalface. And Simon Bailey has been running our internal continued professional development training for the last few years, so by necessity is pretty much always the most technically up to date in the office. If I could please direct you to the bottom of your screen, you should have a Q&A icon. If you could please open that box to post any questions, then I will do my best to triage them as they come in. I'll possibly group some together if they have a similar theme, so don't be surprised if it's not exactly your question that is asked, but I will do my best to make sure all the topics are covered. Some of you are clearly a little bit quick off the mark because the first questions are coming in, but to give me a moment, could I please just ask the panel a fairly broad question? There were lots of announcements yesterday regarding spending, but there weren't the significant changes to the tax system that some had predicted. Is there something I've missed, please? Mr. Ken?
Matthew, thank you. No, I mean, if we have a look at the government's forecasts, they're forecasting considerable growth in the economy over the years. You'll have seen that the forecasts have been uplifted for the following years. The government is effectively relying on growth in the economy and tax revenues produced by natural growth in order to try and fund all their spending plans. Now, it remains to be seen if that growth actually materializes and if the actual tax revenues amount to what was expected and if they actually balance the books with the spending. But the government has, let's say, gone down the route of an economic growth rather than a high tax policy at the moment.
Richard, have you noticed anything, actual big changes in the tax at all?
No. And reading the press this morning, the press are all saying when is tax coming, because this doesn't feel like a normal budget. Perhaps there was the perception from the Chancellor with the OBR's forecast of inflation hitting 5% next year that he didn't feel that the public could stomach tax rise at the same time. So perhaps that also factored into it, as well as relying on growth, as Ken said.
That does, of course, mean potentially more pain down the road if the growth isn't there. It could be more a sharper shock later on. So I guess it's a case of sort of planning and making sure you've got contingencies.
Yeah, absolutely. If I could start with a question that's come in, please. £4.9 billion the government has announced for the British Business Bank. This is for regional funding programmes. How can you get hold of some of those funds, please? Simon?
First of all, speaking to your banks for looking at finance, I think we saw a lot of support through COVID times, which came sort of, although it was government supported, it was through your banks. I think that's your first port of calls, to speak to your relationship manager. Make sure you've got sort of good business plans and forecasts in place. I think without that kind of supporting documentation, it's going to be hard to access any funding at all. So make sure your sort of books in order and you know what you're going to be, or how you intend to be trading, what you're going to be using the money for. And I think the finer details are going to be, or hopefully come down the line. But we've seen the last 2 years, they've certainly been willing to support businesses to try and help them trade through, which is, so we've not seen too many fall by the wayside just yet. But I suggest, now we're moving into a time where some of the delayed taxes are going to be repaid and some of the earlier loans are going to be repaid. I think there's a lot more to factor into your cash flow. So, but yeah, so just be prepared to make sure your books are in order, and you'll be in a good place when the final detail emerges.
So, Richard, it sounds like it's normal sort of methods to get your funding from your normal bank, using the normal sort of forecasting that one should generally be doing anyway. There's not magic, no magic answer to it. Is that about fair?
Most of the finance over the last 18 months have been accessed through your normal banking relationship. There is the startup loans that's offered directly from the British Business Bank. You just go online and apply for it. That's up to 25,000 per business owner. So if you're directors or partners, at 6% interest, loans are over 5 years. Business must be less than 2 years old. So it's initial early doors loans. No personal guarantee, but it is a personal loan. So it's not lent to your business, which does give an issue for tax relief if you're using it in a corporate shell. So although there's no personal guarantee, you are personally liable for it. So it's as good as.
Okay, super. Thank you very much. R&D tax relief. There are changes for non-UK spending. Ken, when do these come into effect, please?
Thank you, Matthew. Well, yes, the announcement the Chancellor made was that they would take into effect from April 23. The intention being to try and restrict the research and development reliefs available for expenditure carried out overseas. The Chancellor said he wished to focus the relief on expenditure carried out in the UK. At the same time, there's going to be some changes as well in terms of allowing research and development expenditure on cloud-based application, which is one of the changes. What I would say though with the research and development is we've seen a massive change in approach from HMRC over the last few years. I think it's fair to say that probably 5 years ago, HMRC were approving a lot of projects with perhaps very little review. Now they're reviewing extensively claims and also looking at some previous claims as well. It's
thanks, Ken. You preempted my prepared follow-up question. It's big changes.
It's a very big change in emphasis, and which we're seeing.
So that's something where you don't see it in the budget, but actually there is a change in the way you want to be looking at your taxes anyway.
Absolutely.
Added on to that, if I can, they also announced some additional funding for the Innovate UK sort of funding, which is something a lot of our clients have already been making use of, and we've seen that coming through more and more. And that's actually quite generous direct funding on particular projects. I think in some cases up to sort of 70% of the project costs can be funded. Obviously, you've got to do a lot of detailed work and applications before it starts, and there are some rules to follow. And you'll need an accountant alongside to be submitting reports. But actually, that's quite a generous scheme. Obviously, there's no repayment. It is a grant subject to certain conditions, and I think they've announced an extra sort of billion into that pot. So that's something I think we'll see coming through more and more. Which normally sort of goes alongside, but you do have to be careful if you're running projects that you're not kind of accessing two different types of funding at the same time. So you do have to be careful of that, and in particular if you're claiming significantly on R&D as well, there are circumstances where you can kind of scupper one by taking the other. So two different, yeah, exactly right. So so do both worth looking into, but you do need to kind of consider it all in the round as well.
A lot of the financing we talked about with a British Business Bank is also state aid, so there is interplay there.
Yeah. Something that's not directly the budget, but is recent changes to tax, and it's changing the way people should be looking at their planning going forward. We've got the increase in corporation tax coming not too far away. We've had the increase in national insurance, now the increase in dividend tax. And I was slightly before the budget, but they're all fairly new. Does that change the position for the sort of the business owner who has a small company, has tended to pay himself small salary and dividends over the year? Is there a change in the way that balance should be going forward? Richard, can I start with you, please?
I think the first thing to say is there isn't a difference between dividends and salary. The dividend tax is going up by 1.25%, as is national insurance for salary. So the differential remains. What is very relevant, as you said a minute ago, Matthew, was the increase in corporation tax rates from April 23, currently from 19% up to 25%. Looking at the calculations, if you take all your profits out, you're still better off on a dividend extraction route. The main difference being the employer's national insurance, which you save by way of dividend. The other thing to think about in terms of income extraction is look to see if you can charge your company interest for money you've lent it. So if you've lent your company money, or perhaps if you vote your dividends at the start of the year, so you have a director's loan account, then consider charging interest. If you're a basic rate taxpayer, the first £1,000 worth of interest is tax-free. Higher rate taxpayer, the first £500 is tax-free. Over and above that, it escapes the extra 1.25% tax charge that applies to dividends and national insurance.
If you also rental income's not subject to national insurance as well, so you've got assets that are used by your business. You can look at kind of sort of renting assets between yourself and the business as well. And as Richard says, it's not changed significantly, the decision between salary and dividends, but it certainly squeezed the gap over recent times, probably more significantly when they brought the 7.5% tax in. But there are some peculiar sort of points of the tax where if your company is actually paying at the marginal rate, so that's when it's in between profits of 50,000 and 250,000, there's actually a slightly higher tax rate you're paying of 26.5%. If your profits fall in there and you happen to be also additional or higher rate, there can be a sort of peculiar times where actually there is a point where salary is actually slightly more tax efficient than dividends. But normally in the rounds, as Richard says, it's normally if you're extracting everything, it should normally work out still better, but it's a lot closer than it ever used to be.
Perfect simple tax system as always. Yeah.
Exactly right. Yeah.
And just one other point on that as well is, of course, clients will remember that when the furlough scheme came in, those clients who had one-person businesses were not able to gain any substantial furlough grant for themselves. There was lots of criticism of the government of the sort of missing quarter of people who would otherwise extract their income from small one-person businesses by way of dividend.
Yeah.
And
yeah.
So I think a number of people may have thought, well, with these changes, yes, the figures may be marginal, but on balance, we might prefer to go down the salary route if furlough ever comes back at a future stage.
Yeah. And just linking back to the previous question on R&D, one thing that's sometimes missed is when you're looking at this particular point, absolutely, if the director involved is involved in R&D of the business at all, then obviously dividend income doesn't count as a qualifying cost, whereas their salary would do. And I don't think they have to do very much in the way of R&D to make the salary route sort of tax efficient in the round. So if you're doing R&D, that question or the answer then changes as it does with when all of these interact. But just watch that.
Absolutely, Simon. Very good point. And I think we may see a move towards sort of small salaries rather than dividends in the future, but it depends on exactly the individual circumstance, and one has to calculate it overall.
As a mathematician, Simon, I know you're loving all those little equations, so that's perfect for you. Another question popped in. Anything? We haven't seen anything regarding entrepreneurs relief. Is anything been missed on that, or is that just continuing as was? Simon?
Well, I mean, one point to note, I think it's now under its current guise I think it's now known as business asset disposal relief. Yeah. Of course, there's been a lot in the press in the sort of tax sector attacking that, and also looking at the corporate capital gains tax rates themselves. I think the Office for Tax Simplification are suggesting they should align more with income tax. We've not seen that. But of course, in a more recent budget, there was they reduced the lifetime limit from 10 million down to 1 million. So that relief itself has been curtailed. So it's taking out a lot of very large gains, but it's still benefiting a lot of smaller entrepreneurial businesses that might benefit for a 10% tax rate on at least the first million. So it's still fairly valuable relief. So it has been restricted, I'd say, in recent years, so it's not a huge surprise that it's not
in recent years, but not this time.
Yeah, so it's not a huge surprise that it's not been sort of re-looked at again at this time. And as Richard says, with inflation and everything else, they weren't looking for too much in the way of bad news. So there was very sort of little in the way of tax cuts.
Yeah. Ken, I mean, you're always pretty good on the history on this. I remember that previously there has been a push to sort of equalise capital gains and income tax. Happened before, but then we've moved away again. I mean, expectation, but again, say the talk beforehand was there would be an equalisation of income tax and capital gains, but that's obviously been avoided again. Thoughts on that? Will that happen in the future?
It may do, Matthew. I mean, just thank you for sort of mentioning my long knowledge of history.
he just means you're well read, Ken.
Why don't you just say I'm old? But no, so on a more serious basis, capital gains came in 1965, and it was at a rate of 30%. Now that was at a time when income tax rates were very substantial. We're talking about the sort of 80%, you know, those sort of rates where you know, there's a huge difference. And capital gains tax stayed at 30 for a considerable time until around the sort of mid-1980s, when the then Conservative government equalised them at 40%. And that was quite a big thing. And I remember at the time, a lot of tax plans were done to try and reduce that capital gains tax rate. And there were all sorts of schemes. But then that went to a complete change with the taper relief at 10%. And gradually we've been moving back up towards, with the rates creeping up a little bit. What I would say is that in terms of contribution to the whole exchequer, capital gains tax is a relatively small amount in relation to the overall position. So for example, something like the national insurance changes contribute a very substantial amount compared with capital gains tax. And I think a lot has already been done with capital gains tax to reduce the sort of benefits. I mean, remember previously we had the taper relief, which gave an overall 10% rate, irrespective of whatever the level of gains were. Then it changed to entrepreneurs relief. Then there was a restriction of 10 million entrepreneurs relief, now backed with a business asset taper relief to 1 million, at which time the gains are at the higher rate of 20%. Personally, I would be surprised if the rates were equalised in the very short term. I think it would be quite an unpopular move. And as a sort of, for the government, it doesn't really want to discourage people from selling businesses and having a sort of, you know, economic activity going on. So
you want the activity over here to get the other taxes in as well.
Absolutely.
And the capital gains is a relatively small amount of the total tax take. So yeah, it's
of course with
balance.
Yeah,
of course on death, subject to sort of new rules coming in, capital gains are effectively wiped out. So if people don't sell in lifetime, it's tax that's potentially lost. So they don't want to discourage it completely.
Yeah, I do think that's one change, Simon, you've alluded to, which may come at some future stage, because there is a little bit of a unusual situation where on a person's death, the potential capital gains on assets they hold is wiped out. So if a person, for example, one spouse dies and passes their business on to the other spouse, the transfer between spouses is tax-free. And there'll be an uplift for capital gains tax to the current value of that business, which means that the spouse can then sell on the business tax-free. Yeah. Now, that's one thing which has been suggested. There may be some change to, but it didn't come this time.
Is there anything people ought to be doing with that in mind, Ken?
Well, there is planning, Matthew, which goes around where one spouse is unwell or perhaps you know, maybe close to death. There are movements where investment properties have been moved around, shares have moved
So if there's
around.
going to be change to the legislation, is there anything people ought to be doing in preparation for that potential change, or it's too far down the line to really consider?
I think it's likely to apply on the date of death, and obviously we wouldn't. Yeah. So obviously,
plan too much.
Yeah, exactly. Yeah.
Super, thank you, Richard. For registered charities, are there any? Is there any help for them going forward? I'm aware that for, is it museums that there's theatres? There's some assistance coming through. How do those reliefs work, please?
There is reliefs available for the museums and theatre sector. Also, if it's a hospitality sector as well, there's the 50% rates relief that comes in from April. Simon, have you seen any more of these?
No, only that I think they're trying to support small businesses in general, particularly hospitality trade. So I think they're trying to make sure that everyone's got access to some form of business rates relief. I think they said at least 50%. So I think some could see more than that. Obviously, the finer details will be sort of coming out. We've seen recently sort of reduced VAT rates in some sectors. So I think some other reliefs have sort of been extended in those sectors have been extended through to sort of 2023 or 24. So I think they're not looking to certainly not looking to take away any support that's currently around. But I'm sure we'll see the final detail.
Better targeting as well, isn't there, from next April?
Yeah.
Particularly on touring theatres and the like.
Yeah, I mean, they'd introduced a sort of cultural relief rises. I think cultural relief rate rises, like it's referred to as, and there's specific tax reliefs in place already for the sort of theatres, art galleries, performing arts, etc. And what they've done is they've made some increases in the rate of relief, which works on the basis of giving you a higher relief for expenditure. They've also a provision where you can surrender some losses to take cash, and those are being looked at as well. So there's a number of sort of changes coming through to 2025, and in those cases they're going to taper down gradually over the next few years.
Thanks, Ken. Simon, I think in one of your next updates for our CPD, the £1 million of annual investment allowance is going to be extended again, which is a huge surprise. Why is it that keeps being extended as opposed to just setting it as a flat rate?
I think largely it's so that when they have quite a quiet budget, like we saw yesterday, they've actually got something to say. Because I think that was pretty much the only kind of new tax announcement that we saw, really. And yeah, like you say, we've done some recent training and planning on what to do when we move. Of course, it's currently £1 million of qualifying plant and machinery and assets that could be spent, and you get the tax relief up front through your businesses. That was set to drop to 200,000 at the end of this year. They've now extended it to March 23. So that coincides with the new increase in corporation tax rates. Of course, dovetailing with that, we've also got this new super deduction that's in place for 2 years up to that same date, just to try and stop people from delaying capital expenditure until the rates increase. Obviously, you'd normally want to spend during higher tax rates and earn while the rates are lower. So they're trying to encourage that. I think if you do have a business that is looking at spending significant amounts on capital expenditure over the next year and a half, 2 years, I think just make sure you do the planning in terms of timing, especially if your year end spans either December's or March, because that can make a big difference as to whether you get the relief or not. And also this super deduction and annual investment allowance, one is capped, as we see, it's still £1 million. The other one is uncapped, but they do apply on slightly different assets. And there are some assets you would want to use one over the other. So it is worth planning ahead and looking at what you need to spend and when. And which relief is going to be used. So it's still plenty there, but yeah, you're right. I'm going to have to update my slides.
on which note, we've got possibly my favourite question of the day so far just come in, which is just on that planning point. Richard, we've got CT rates about go up. Should you buy an asset now to reduce your CT, but at corporate rates at 19%, or should you be waiting until the CT rates increase so you're getting a better deduction?
Thank you, Matthew. It depends what the asset is. If it qualifies for the super deduction, then that will give you an effective tax relief now at 25%. So, which is the tax rate that comes in from April 23. So, if it qualifies for that, then don't delay the spending. Yeah. If it doesn't, then perhaps. But it really is a case-by-case basis.
Of course, funnily enough, if your profits are actually looking like they're going to be below 250,000, of course your actual marginal tax rate is 26.5%. So depending on the scale of it, there's you're as you always are, you're looking at small savings versus cash flow. So
so that was my point. I was going to say cash day versus cash tomorrow. It's return to 2009 and cash is king. I think we want the money now.
The super deduction and investment, the biggest kind of subtle difference between the two is that super deductions are only available on new assets, not just new to the business, but new and unused assets. Whereas the annual investment allowance is anything that's kind of new to the business, whether it's secondhand or otherwise. So
Simon, also remember the super deduction also applies to companies.
Only companies,
only companies, And just a little observation that the change in moving the annual investment allowance from the end date, as it was going to be, of 31st December 22 to March 23, means that the super deduction, the annual investment allowance, and also the planned increase in corporation tax rate are all aligned on the same date. Which was, whereas previously they've been slightly out of sync.
Next one in, given the changes to van benefits, is it still good tax benefit, still tax efficient for the company to own a van? And I think people are thinking about benefits in kind on this. So it's the personal income tax associated with the benefit in kind for a van. So is it still good to have a van? Should people looking to move to electric vehicles? Richard, any recommendations there, please?
Okay, I think the first thing I'd say is that the sort of vehicle I would buy is not necessarily the sort of vehicle I'd advise clients to buy. Certainly in terms of the van benefits, the increase is fairly small. It's increased by the Consumer Prices Index percentage. So it's still cheaper than the equivalent car if you're happy to drive around in a van or a double cab pickup. Otherwise, electric cars are more expensive, but they are very tax efficient if that's the way you're looking to go. So the company or your business can get full relief for capital allowances purposes against your tax liability. If you're an employee, then your benefit rate this year is just 1% of the list price. Next year it increases to 2%, so it's a fairly small tax liability.
Go on then, let's put some context to that. 1% coming up to 2% compared to a traditional old-fashioned gas guzzler, we're up to like 36-37% at the top end.
That's exactly right. The other
and
thing
on the list price as well, every year on the list price,
no matter how old the vehicle is. The other thing I would say is it does depend on a business structure. If you're an unincorporated business, a sole trader or a partnership, then the car benefit rules don't apply to you. It's just a question of how quickly you get relief for tax purposes based on the emissions. The car benefit rules only apply for corporates.
And the other thing to watch is if you've got traditional sort of company cars, if fuel is provided for the employee as well, there's quite a sharp additional tax that's paid for providing fuel. They've kind of clarified that electricity doesn't count as fuel. So if you do have an electric car, all electricity can be supplied and paid for by the employer as well for no additional benefit. So there's definitely a push to try and get all sort of commercial fleets towards electric by their sort of target date in the sort of 10-15 years to come.
Fantastic, thank you. Ken, we've got inflation sort of somewhere between 3-4%, something along those sorts of lines. That's comfortably above the Bank of England's target of the 2%. Will they do anything about that? Would you expect them to? What's your thoughts?
What are my thoughts? Well, I mean, it's a difficult one really, Matthew, because inflation is often caused by an economy booming with lots and lots of spending. This is a slightly different type of inflation, which is caused by rather a lack of supply. So we have a slightly different one, an increased cost of sort of core materials rather than an economy booming totally control. I mean, the ways, in fact, inflation have often been controlled traditionally it used to be by the government operating both increasing taxes and increasing interest rates. Well, of course, now things are a little bit different with the independence of the Bank of England, who control interest rates. And I mean, that's had quite an effect on the way the government sort of managed the economy in the past, because again, and the Bank of England traditionally, when the economy was low, they would reduce interest rates. Well, when you've got interest rates down at 0.25%, there's not an awful lot you can go lower. The problem the government and in fact the Bank of England both have now is that if you look to control interest rates, control inflation by upping interest rates, people have been used to these interest rates for a very long time. Mortgages are often a function of how much per month will it cost me, and with low interest rates, they've been very cheap. The concern is, if suddenly interest rates were to go up to the sort of 3% or so, which some of the popular press have indicated, that would have a major effect on people's money in people's pockets as mortgage interest rates went up, effect on businesses. So it's a challenge, and big challenge.
The other thing to add is if interest rates do increase, it will increase the government's interest rate bill on the eye-watering amount of debt we've got at the moment.
Yeah.
So
Absolutely.
at the moment they're borrowing. We spent the government borrowed £1 billion a day for the last 18 months.
Yeah.
Based on low interest rates, if all of a sudden they increase to, and the press are talking about 3.5% and that sort of thing, it does increase the bill for the taxpayer.
Yeah, I was looking at, is it 40 billion a year our interest is likely to be, that sort of order?
Yeah.
I mean, that's an interest increase would not be brilliant for the government either, I don't think.
I mean, it is going to be a worldwide problem though, because I mean, if you again look historically how governments have dealt with huge lumps of debt, often if you look at sort of wartime debt and you look back at the sort of First World War debts, which I think we ended up finally paying off about 3 years ago, and it had been consolidated with a little bit of an old Napoleonic debt. Whereas the Second World War debts tended to be cleared by the sort of rampant inflation of the 70s.
Yeah. It always makes me laugh when the headlines read that the debt's down, but it just means that they've borrowed slightly less this year than they did the year before.
Yeah.
Yes.
Richard, I know you work quite a bit on this. There's a new tax for residential property developers. Is this an additional tax, a new tax, and how is it going to work in practice, please?
It is a new tax. It's a new tax rate, 4%, so not an expensive tax rate in the scheme of things, but it does only apply if you're a property developer and your profits in excess of 25 million. So it really does capture the larger developers. It's intended to fund the Grenfell type work that's needed after that. But so it's a large developer tax.
Possibly slightly more relevant, but in that kind of space, recent years we've seen a shift for sort of individuals having to report their gains on any UK property. So if you have to pay tax on any UK property sales in the last sort of year or so, then you've had to pay the tax within 30 days of completion, but also submit a return. I think that obviously that came along with sort of COVID, so it took a bit of a sort of bedding in. I think they've just announced that the deadline is now going to be 60 days. So you've got twice as long to get that in. But I think we're still getting sort of clients coming to us to tell us about disposals in the year when we're preparing their tax return, but they weren't aware that there should have been a return filed at the time. But so from yesterday, they've now 60 days to get that in. So hopefully just the awareness levels increase on that, and obviously we're here to support.
Thank you. Inheritance tax, again, there's been some expectation that things are going to change with regard to that, but no announcements yesterday. Ken, is that correct?
No, absolutely, Matthew. But again, inheritance tax is a very unpopular tax on the basis that people pay tax
as opposed to
a popular tax. That's true. I mean, I was always told no client ever is happy paying tax, or very few clients happy paying tax. But no, it's probably one of the most unpopular of the unpopular taxes. I think it's probably fair to say, Matthew, on the basis that people pay tax throughout their lives, and then there's an extra tax on death, and it's at a high rate. I mean, there's no sort of lower rates or tapering. You're talking about 325 per individual, possibly with the extra 175 property allowance. So that would make £500 per individual, 500,000 per individual, £1 million per couple. And after that, it's at a straight 40%.
The mill rate band has been unchanged for the last 12 years, so it's inflation has dragged a lot more people into the inheritance tax net.
And the moment your estate exceeds 2 million, you start to lose the additional rate that they've brought in as well. So for larger estates, you are looking at pretty much 40% on the whole lot, really. So
on the whole lot, above 625, yeah. I mean, so no, I think the point Richard makes, right, is that it's being eroded by inflation. The benefits are being eroded by inflation. But no, I mean, one of the things which has been in place for a long time, which has sometimes been suggested they look at, is the business asset reliefs. But equally, for a government point of view, they want to encourage businesses, family businesses, to pass down through generations and not to be sort of held. So I think you'll find that business asset reliefs are probably safe for a little bit anyway.
Get plenty of taxes from the PAYE, the VAT, the national insurance, all the others as well. So yeah, I guess it's key for them to keep those businesses going.
Yeah, I think what the government's done, Matthew, is it's focused on the sort of bigger money earners budget, and things like the additional national insurance is a considerable contributor to the exchequer, and that aligned with what they did a few years ago when they put the dividend tax on as well. And to be honest, politically, it's probably easy to levy something like national insurance because it's seen as a fund for the sort of good of the country and support the NHS, etc., than to levy certain other taxes. So
taxes you can't get around as well, isn't it? So with capital gains tax, you can choose not to sell and not to pay the tax. Whereas with your income in terms of dividends and salary, you're going to pay it.
Yeah.
Another question's coming in, I think one we'd all have sympathy with. Individual director and shareholder of a small business that doesn't feel they make huge profits. And now you've got the increase in national insurance, you've got the increase in national living wage. For them in their business, that could turn small profit into no profit or possibly loss. What can they do to try and help them get through these sort of problems? And is there anything to do to alleviate them, Simon?
I think as with all these sort of changes coming in, I think businesses just need to make sure they've got sort of up-to-date management accounts and reasonably sensible forecasts to see what it means for them. Of course, there's going to be some industry sectors hit harder than others. If you're already paying most of your staff above the sort of living wage and minimum wage, then obviously that change in particular won't impact you as much. But obviously there are a lot of sectors that a considerable proportion of their staff are paid at that level. So it is going to be quite an impact if your sort of wage bill is going up by sort of 6 or 7%. So just I think it's forecasting and planning, see what it means, and talking to banks and understanding what it means in terms of whether you can sort of pass on the increases through your sales prices, really. So
there's certainly
remodeling. Richard, Richard, I was going to say, so is this sort of remodeling or just double checking your business model to make sure you understand where you're making your profits?
Yeah, exactly right. Thank you, Matthew. I mean, there's a perception of price rises in the economy anyway. We touched on inflation, so it may give you the opportunity to look at your pricing, to look at the top line and see if you can increase that as a starting point. But having good management accounts and forecasting is always key to running a business. Understanding what you're doing well and do more of that, and understanding what's not going well and change your ways. So you can plan accordingly for any cash flow pinch points or any difficult periods ahead with good management information.
Yeah.
I've got someone else who says that they've had staff that have not wanted to work additional hours historically because of the loss of universal credits. Will the tapering changes made make staff more likely to accept the overtime offered, do you think, Ken?
I think it was very welcome. The tapering changes went a little bit further than expected, but there's still a sort of marginal rate of 55% there, and which on a personal basis, I would have probably preferred to see that under 50, on the basis that there's a sort of a perception that if I get more, then they get more, then the government get more, I'm more motivated. That's would have been my personal preference to see that, but I think that will help.
Yeah.
In just tapering on universal credit.
Yes, over the next few months we'll see if that has an effect. Yeah, it's going to be interesting to watch that.
Yeah.
So I think really that brings us to the end of our questions this morning. Team, thank you very much for your time. Thank you everyone for joining us. If you have any further questions, then please do not hesitate to give us a shout. Any of us on the panel, or of course anyone else you know at Burgess Hodgson. We have our budget summary that will be going on our website, hopefully by lunchtime, and possibly slightly earlier. So if you'd like to have a further look at the summary of what the changes are, then please have a look at that. And thank you very much for watching. Hope to see you in person before too long, but for now, have a great day. Thank you very much.
Thank you, everyone.
Thank you.